Right friends, welcome back to question and answer banking awareness module number 10. We are going to discuss 24 questions in this module. The first and the foremost question is Indian monetary system is based on, at present Indian monetary system is based on minimum reserves. Previously, prior to 1956, it was based on proportional reserve system. What is the difference between proportional reserve system and minimum reserve system? In the proportional reserve system, Reserve Bank of India is required to maintain certain percentage of gold as well as approved foreign currencies. Prior to 1956, it was proportional reserve system. At that time, RBI was required to maintain 40% of currency notes, 40% of currency notes as gold or foreign currency reserves. That was proportional reserve system. That means if the printing of currency notes increases, their reserves will also increase. And in the year 1956, Reserve Bank of India felt that the currency notes are increasing in the market. So, if we follow proportional reserve system, then there may be need for keeping gold and foreign currencies in large quantities. That's why, based on the letter issued by RBI on 6th October 1956, the system was replaced by minimum reserve system. At present, whatever the quantity of currency notes being printed by Reserve Bank of India, Reserve Bank of India is required to maintain only fixed reserves. They are not variable reserves. So, gold and foreign exchange reserves, as per the present system, RBI is maintaining in fixed quantity irrespective of the currency notes printed. Right friends, look into the next question. The difference between the bank rate and the repo rate is 100 basis points as per the monetary policy guidelines. As per the monetary policy guidelines, all of you are well aware, monetary policy is being announced once in 2 months. In any financial year, monetary policy is announced 6 times, and as per the monetary policy guidelines, bank rate as well as marginal standing facility are higher by 100 basis points in comparison to repo rate. In comparison to repo rate, marginal standing facility and bank rate are higher by 1% or 100 basis points. In banking parlance, 1% is 100 basis points, and as per the present monetary policy guidelines, bank rate or marginal standing facility rate are higher by 100 basis points or 1% in comparison to repo rate, and reverse repo rate is lower by 100 basis points or 1%. Please don't forget. And in the monetary policy, at any time this benchmark may be changed, but for the past 1.5 years, this benchmark is being followed by Reserve Bank of India. Right friends, look into the next question. Which of the following does not fall under capital account? All of you should be familiar with current account as well as capital account. In detail, we will discuss in the banking lectures, but for the time being, I will explain in brief what is current account, what is capital account. Current account is basically with regard to the income. Current account looks at income, whereas capital account looks at ownership of assets. Current account looks at only income. Capital account looks at the ownership of the assets. Current account means exports. When we are exporting, we will get some money. That falls under current account. When we import, we pay money to some foreign country. that falls under current account. The third thing is the services. When we are exporting various software related services, then this comes under current account because it is basically income. Then foreign remittances, persons in foreign land, settled in United States of America, settled in Dubai, sending money to their parents, sending money to their sisters or brothers, those are remittances, and this is current account. Let us take the case of Coca-Cola or Pepsi. They invested in our country and they take royalty for using the brand name. So that is the current account. So current account is basically looks at income. Capital account looks at ownership. If some foreign entity, if some foreign portfolio investor is investing money in our stock market, that means they are getting ownership of our companies. If someone is investing in our stock market, if some foreign entity is investing in our stock market, that means they are getting ownership to that extent. If some company is establishing a subsidiary here, suppose Hyundai of Korea is establishing car company here, Ford of USA is establishing car company here, that means they are acquiring assets in this country. So ownership or acquisition of assets broadly categorized as capital account, whereas transfer of income, that is categorized as current account. Of the given terms here, FII or FPI is investing in stock market, that means they are getting ownership of some company, that's why it is capital account. The third one is FDI. FDI is foreign direct investment. They are investing in our country. That means they are having ownership here. They are getting ownership here. So that is again capital account. But the factor income is basically income. When someone is investing in our country, they will take the profits on it, they will take the royalty on it, that is considered as income and it falls under current account. So FPI or FDI falls under capital account, whereas foreign remittances, royalty on the investments, income on the investments, exports, imports, services, these all fall under current account. Please don't forget, this current account as well as capital account put together is balance of payments for a country. Current account, capital account put together is the balance of payments for a country. Right friends, look into the next one. One rank, one pension scheme pertains to pensions in military. Government yet to announce. Retired personnel in the defense forces are eagerly waiting for the government's decision in this regard. This one rank, one pension scheme pertains to pensions in military. What is the meaning of one rank, one pension? If the person is having same rank, if the person has put in same years of service, if the person is same rank, put in same years of service, they should get the same pension irrespective of the year of retirement. Somebody might have retired in 1990, somebody might have retired in 2010, but if the rank as well as years of service are one and the same, they should get the same pension irrespective of the year of retirement. That is the meaning of one rank, one pension, and the present government promised in the run up to the elections that they will implement one rank, one pension scheme, but yet to give detailed orders. But the government is yet to announce the implementation of one rank, one pension scheme, and the retired personnel in military services are eagerly waiting for the government's decision. Look into the next question. Which sector contributes the least to the GDP in India? In India, this primary sector. Primary sector is basically agriculture and its allied activities. Agriculture and agriculture related activities like dairy farming, animal husbandry, agriculture related services This constitutes primary sector, and primary sector contributes the least to the country's economy. Primary sector's contribution is the least, somewhere it is around 13-14%, whereas manufacturing sector is the second one, and services contributes maximum to the economy in India. Services sector contributes around 60% to the GDP in our country. Right friends, look into the next one. If you subtract liabilities from assets, that is net worth. A company has got 5 crores of assets. A company has got, let us assume a company has got 5 crores worth of assets. Assets means you can simply say their properties owned by the company. 5 crores. It has got bank loans of 2 crores. A company has got assets, their own property of 5 crores of rupees. At the same time, the company has got bank loans up to the tune of 2 crores of rupees. The bank loans of company are liabilities. I have explained to you in previous lectures, a liability means when a organization has got a loan, that is a liability. So, net worth is assets minus liabilities. If you come back to the company has got 5 crores of assets and 2 crores of liabilities in the form of bank loans. So, the net worth of the company is 5 minus 2, which makes 3 crores. So, net worth is assets minus liabilities. Right? Look into the next question. Who is the founder of Amazon.com? You should not forget, Amazon is the leading e-commerce giants established in United States of America. The founder of this e-commerce giant is Jeff Bezos, and at the same time for the world giants, don't forget the founders. Mark Zuckerberg is the founder of Facebook. He became one of the billionaires at the early age of 20s. Mark Zuckerberg is the founder of Facebook. Bill Gates and Paul Allen started Microsoft. Bill Gates and Paul Allen started Microsoft. Larry Page and Sergey Brin are the founders of Google. Larry Page and Sergey Brin are the founders of Google, and please don't forget, all these mighty organizations have got their origins in United States of America. Right friends, look into the next one. Trade facilitation agreement is basically meant for, trade facilitation agreement is easing trade between various countries. Easing trade means reduce the barriers, reduce the paperwork, ensure transparency. There should not be corruption, ensure transparency, reduce paperwork, improve the logistics in the ports. Ports should be improved. When a ship comes from other country, it should be unloaded early and it should be relieved immediately. So, these all comes under trade facilitation agreement. So, trade facilitation agreement basically looks at reducing paperwork, increasing transparency, reducing trade barriers, and improving the infrastructure in ports. This all talks about trade facilitation agreement basically to enhance the trade movement with little or no hassles between various countries. Friends, look at the next one. Which of the following comes under capital account? We have just now discussed current account is exports, imports, services, royalty payments, foreign remittances to parents or sisters. These are all income. This comes under income. That is current account. Capital account is foreign portfolio investments in stock market, foreign direct investment into the country like Coca-Cola, Pepsi, Hyundai, Ford, the way they are investing in our country. So, this comes under capital account. Right? In the given question, FDI comes under capital account. The capital account basically pertains to acquisition of assets. Right friends? Look into the next one. Hard monetary policy results in two types of monetary policy. One is hawkish, Second one is the dovish. Hawkish monetary policy or hard monetary policy is money circulation will be reduced. In the market, if the money circulation is reduced, availability of quantum of money is reduced, that is hawkish monetary policy. How it can be ensured? Increase the repo rate, increase the repo rate, increase the CRR, increase SLR, then what will happen? The quantum of availability of money supply will be reduced, because lot of money is held up in the form of deposits, in the form of gold, in the form of government securities. In that case, the circulation of money in the system will be affected, and when the money circulation reduces, what will happen? Interest will increase. Interest rates will rise. When the money circulation is reduced, interest rates will rise. That is called hawkish monetary policy. When the money circulation is reduced, interest rates will rise. So, that is hawkish monetary policy. Dovish monetary policy is interest rates will be reduced when the RBI governor is reducing 1% interest rate in repo, and when RBI governor reduces SLR, when RBI governor reduces CRR, what will happen? Ultimate result is availability of money in the market will increase. When the availability of money in the market increases, what will happen? Interest rates will come down. That is dovish monetary policy. Hawkish monetary policy stifles growth. Growth will be affected due to hawkish monetary policy, but due to dovish monetary policy, because of dovish monetary policy, growth will be there, but because of easy money availability, inflation will also be there. Please don't forget. So, government has to strike a balance, or rather RBI has to strike a balance between growth as well as inflation. And RBI governor several times says, mine is neither hawkish monetary policy, neither dovish monetary policy. It is as per the requirement for the economy. Right, friends? Look into the next one. Which of the following differentiates between GDP and NDP? What is GDP? GDP is gross domestic product. Gross domestic product is the total value of goods and services produced within the country. Total value of goods and services produced within the country, and if you subtract depreciation, depreciation means value of goods goes on reducing as the time passes. Value of the goods goes on reducing as the time passes. That means you purchased a new car. Today the cost is 7 lakhs. Next year it will become 6.5 lakhs. After 2 years it will become 6 lakhs. After 3 years it will become 5 lakhs. After 4 years it will become 4 lakhs. So the value is getting reduced. That is called depreciation. So the difference between GDP and NDP is, if you subtract depreciation from gross domestic product, you will get net domestic product. The difference between GDP and NDP is nothing but net domestic product is nothing but gross domestic product minus depreciation. Right, friends? Depreciation is the reduction in the value of the assets as the time passages. Right, friends? Look into the next one. In UDAI, all of you are well aware, UDAI issues Aadhaar cards. UDAI is the Unique Identification Authority of India. Unique Identification Authority of India. Now, Planning Commission is no more in existence. Niti Aayog came in its place, and Unique Identification Authority of India gives Aadhaar cards. Right, friends? Look into the next one. In the banking parlance, total business means, please don't forget, total business means banks total deposits plus total advances put together is called total business. Right, friends? Look into the next one. Many corporates are tapping the route of commercial paper. Commercial paper, please don't forget, it is a short-term money instrument, short-term money market instrument issued by high-rated corporates. High-rated corporates issue commercial paper to borrow from the market. That too for short term. Why they are not going to banks? Why they are borrowing from market? You look at Reliance Industries. By issuing commercial paper, he borrows from market for short term, not for long term. By issuing commercial paper, he can borrow for short term up to 1 year only. But he is not going to bank. When he goes to bank, he has to pay interest of around 12% or 13% or 11%. Because bank's base rate is around 10%. But he is getting money because several software companies are flooded with money. Infosys has got cash reserves. Similarly, Wipro has got cash reserves. And the companies like Reliance Industries, highly rated corporates, can borrow money from market at much lesser interest rates. That's why they are not going to the banks. So the answer here is third one. The base rate of banks is high and the market rates for commercial paper are lesser than the interest rates charged by banks. Nowadays, for the past 3-4 years, corporates are borrowing from market instead of going to banks for their short-term needs because the interest rates in the market are much lesser in comparison to the bank interest rates. Right friends, look into the next one. Cash credit is normally granted against. I would like to tell you cash credit account as well as overdraft. Cash credit account or overdraft account, these are termed as a revolving credit. Please don't forget, if you are taking vehicle loan, if you are taking a house loan, if you are taking personal loan, bank will give you money at once. If you are taking 3 lakhs loan, personal loan, if you are taking 3 lakhs personal loan, bank will give you 3 lakhs at once. You have to pay monthly installment to bank. That is servicing of loan. But in case of this cash credit account or overdraft account, limit is given by the bank. Suppose the bank has given 5 lakhs limit. Limit 5 lakhs. If bank has given 5 lakhs limit, you may or may not use it. If you use 1 lakh, you will pay interest only for 1 lakh. If you use 3 lakhs, you have to pay interest for only for 3 lakhs. If you use 5 lakhs, you have to pay interest for 5 lakhs. But remember, the limit given by the banks cannot be exceeded. Up to the limit given by the bank, you will take some amount with some interest, with the agreed interest, you will pay back. You take the loan, pay back, take, pay back, like that. As and when you require, subject to the limit, you will draw money from bank, that is bank's money, not your money. You will draw money from bank and as and when you get money, you will pay back. Taking money, paying back. Taking money, paying back. That is a revolving credit. Revolving credit is cash credit as well as overdraft facility. But there is a slight difference between cash credit and overdraft facility. In the cash credit, the security is the items manufactured by you. You are manufacturing computers. You have 1000 computers in your godown. They will allow you cash credit against the hypothecation of computers. That means the items manufactured by you, in this case computers, are the security for bank. In case of overdraft facility, the security may be some shares, some fixed asset. Those are the securities for overdraft facility, but for cash credit, the security is goods manufactured by you. That is the slight difference between cash credit and overdraft. But please don't forget, cash credit and overdraft, these are the mechanisms given by the bank in the nature of revolving credit. As and when you require, you take, and as and when you get money, you pay. But you should not exceed the limit given by the bank. Right friends? Look into the next one, the ability of a asset. The ability of an asset to get converted to cash easily. The ability of an asset to get converted to cash easily. You should be in a position to convert it into cash. That means, what is the purpose of currency notes? Currency notes in your pocket, what is the purpose? The basic purpose is they should be useful as a medium of exchange. If you want to have a cup of coffee, your currency note should be useful as a medium of exchange. The shop owner or the tea shop seller or the tea stall seller should be in a position to take your note and give you coffee. That means, whatever money you have, that should be useful as a medium of exchange. Otherwise, there is no point of having money. And the assets which can be converted to cash, that means which can be used as a medium of exchange, are liquid assets. If you have dollars, if you have euro, if you have cash in your pocket, if you have savings bank account, you have 10,000 rupees in your savings bank account, you have government bonds, these are all liquid assets, because without the loss of value, you can convert them into cash. Currency notes is already cash, you can use it as a medium of exchange. Similarly, if you have dollar, if you have euro, if you have government bonds, at the same time, gold is also considered as a liquid asset because of the reason, without the loss of value, as per the prevailing market rates, you can sell gold. So, the assets which can easily be converted to cash or which can easily be used as a medium of exchange are liquid assets. So, the ability of asset to get converted to cash easily is liquidity. Right? Look into the next one. Name the bank which acquired ING Vysya to become the fourth largest private sector bank in the country. This is the Kotak Mahindra Bank. All of you are well aware. Kotak Mahindra Bank acquired ING Vysya. ING Vysya has got footprint in southern part of the country. So, to have pan-India presence, Kotak Mahindra Bank acquired ING Vysya Bank recently. Now, it became fourth largest private sector lender in the country. Look into the next one. The RBI has decided to stop circulation of coins of which of the following denominations from June 2011. RBI stopped circulating 25 paisa coins, or you can say it ceased to be the legal tender. What is legal tender? It should be acceptable, no one can refuse it. If you have 10 rupee note, that is legal tender. If you have 20 rupee note, that is legal tender. 25 paisa coins have gone out of circulation based on the RBI's instructions on June 29th, 2011. Now, they are no more legal tender. Right, friends? Look into the next one. In NOFN, F stands for fiber. NOFN is the National Optical Fiber Network. National Optical Fiber Network, which plans to connect 2.5 lakh villages across the country. Right? Look into the next one. Which of the following comes under revolving credit? We have discussed in detail. Overdraft facility is revolving credit. Overdraft facility or cash credit. There is a small difference between these two. We have just now discussed. So, overdraft facility comes under revolving credit. Right, friends? Look into the next one. We know about Ebola virus. It is the name of a river. Democratic Republic of Congo. This river exists in Democratic Republic of Congo, and the deadly virus, that is Ebola virus, is named after a river. Please don't forget. In terms of section 51E of the Banking Regulation Act 1949, a banking company means, what is the meaning of banking company? There are three things given. One is which transacts the business of banking in India. Which transacts the business of banking in India. Second is which accepts a deposit from the public and gives loans, accepting deposits, giving loans. The third one is some of the accepted deposits they can invest in trade and industry. They need not give all the deposits whatever they are taking. They have to keep something for CRR and SLR. After keeping aside for CRR and SLR, remaining deposits, There is no such rule that they have to give 100% of remaining deposits as loans to customers. They can invest also. They can invest in shares, they can invest in trade and industry. So that means these three are correct. As per the Banking Regulation Act, one is which transacts the business of banking in India, second is which accepts deposits from the public and gives loans, third is which invests in trade and industry, right? These three are the norms prescribed as per Banking Regulation Act. Which of the following instruments of credit control adopted by Reserve Bank of India does not fall under general or quantitative methods of credit control? There are two types of credit controls. One is quantitative method, the other one is qualitative methods. One is quantitative method. Quantitative method is controlled by Reserve Bank of India. That means to ensure the required money circulation in the economy. To control money circulation in the economy, RBI does quantitative credit controls. RBI does quantitative or general credit controls. What are they? All of you are well aware. The controls exercised by RBI are CRR, SLR. These two are called reserve requirements. CRR, SLR. What will happen if CRR is increased? If SLR is increased? If CRR is increased, if SLR is increased, money circulation in the market will be reduced. Similarly, repo rate, bank rate, when these rates are increased, again money circulation will decrease. Third thing is open market operations. What are open market operations? Open market operations are nothing but buying and selling bonds, government bonds in the open market. That also controls money supply in the market. So these are called quantitative measures exercised by RBI directly, general or quantitative credit controls. There are other ways of credit control also. They are qualitative credit controls. Please understand the difference. Quantitative credit controls are exercised directly by Reserve Bank of India as part of their monetary policy, whereas qualitative credit controls are exercised by banks, individual banks, subject to the instructions given by RBI or Government of India from time to time. That means at present you are getting 75% of the value of gold. Let us assume you are getting 75% of the value of the gold as a loan. Tomorrow RBI stipulates you should not give more than 60% of value of gold. That is the qualitative credit control. Right? Tomorrow if RBI instructs banks, please reduce the loan you are giving on gold, then that is qualitative credit control. In the house loans, if banks are giving 80% of the value of the house as loan, tomorrow RBI may say, please give loan up to 70%. That is qualitative. So quantitative is exercised directly by Reserve Bank of India. Qualitative is exercised by banks subject to the instructions. Right, friends? Look into the last question. Which of the following organization is responsible for clearance of government securities among banks and financial institutions? Government securities, GSECs, are purchased by banks as well as financial institutions. The organizations which trade in these government securities are called primary dealers. Please don't forget, the organizations which trade in government securities are primary dealers. But the organization which clears these amounts among banks and financial institutions is CCIL or Clearing Corporation of India Limited. The difference, please see. The organization which transact business of government securities is primary dealer. The organization which transacts business in government securities is primary dealer, whereas the organization which clears these amounts between banks and financial institutions is Clearing Corporation of India Limited. Please understand the difference between primary dealers and Clearing Corporation of India Limited. With this, let us wind up 10th module of question and answers. Please do join for 11th module. Have a nice day. Thank you.